Firstly, thank you for joining us, this IP Global's beginner's guide to property investing. Basically in the brave new world of webinars and us covering all sorts of topics. Actually, it was we kind of wanted to bring one that was back to basics, really. There's lots of people on different stages of the property journey, and appreciate actually one of the most important steps for anyone is just starting and getting your head around the whole property world, where you fit into it, and how you can get involved and take advantage. So today is going to be a little bit about information for those people, first timers, new starters, but even some seasoned property people who've been doing this for a while, because the basics really are applicable to anyone, whether you're starting or been doing it for years. It's basic fundamentals of research and planning, largely. So firstly, I'm Jeremy Marshall, Director of Wealth Management here at IP Global, based in Abu Dhabi. Been with the company for 8 years and look after clients all over the world, Europe, Middle East, Asia, to help buy into developed markets. And together with me here we have Sai Navani, who is a previous client of IP Global. Just so you know, I've actually not met Sai before, apart from once before today's call. So we'll be asking him a lot of questions about his personal journey throughout his purchase with us, and what it feels and looks like to get into property. But Sai, do introduce yourself. Let us know where you are and who you are.
Sure. Hi everyone, good morning or good afternoon. So as Jeremy mentioned, my name's Sai Navani. I work with IP Global's sister company in Hong Kong. And just a bit of background about me was that I purchased my first property through IP Global about 4 years ago. I'll be going through about my process investing in that property, and just the knowledge that I gained of investing for the first time and where I am now as well.
Perfect. Thank you very much. So what we're going to be covering here then, a little agenda for today, short and sweet really. We're going to start with just the basics, and some bit might seem quite self-explanatory or simple, but it's really important to understand how property fits into the investment world and how you make money from it. What are the positives, what are the negatives of property, how you might want to fit that into a longer or larger portfolio over time. Secondly, we're going to be looking at what type of investor you are. It's all very well saying it's not like a supermarket. You can say this property is great for everyone. It's not like taking something at the supermarket shelf there. Each individual and their life circumstances completely changes what property might be suitable for them or how they'd like to go about it. So we're going to look a bit about how you can ask yourself what your investor profile is, and then what that will dictate what kind of property you might be interested in looking at. The most important, when you're starting out, just to go, how do I go about this? Where do I start? How do I pick the right property? There's a lot out there, and largely this is going to come down to research. So we're going to look at what to look at, how to look at it, where to look for it, and to really narrow down the options and reduce your risks in the process. And then lastly, to kind of make this real, we're going to have a look at actually what does the process look like, from the point you decide to commit to it, what's your obligations throughout it, who's there to help you, how long would it take, and what does the journey look like for the years following it when you own the property. And lastly then we'll have an opportunity at the end there's for Q&A. So you can see there's a Q&A box there, so by all means, if there's points on certain slides we're discussing you're interested in or have questions about, pop those in, and we'll try and cover as much as we can towards the end. There's plenty of different questions, plenty of different ways to come about this, so please do get involved. Now, just to give reference then, why we are bringing you this webinar. I appreciate that a lot of you might not be familiar with IP Global, coming in for the beginners webinar, but just we are one of the most established and experienced property investment providers, particularly to the expat community around the world. And we offer a full service for people who want to buy into property. So you know, the most important thing obviously is our research and bringing the right assets to you, and we'll have a look a little bit about the research and how we go and buy into those. But actually we can help with absolutely everything throughout the process. So we're not an agent who's going to sell something. We are a partner effectively for the entire lifespan of you owning a property. So we can help with everything from the mortgages. We've got the lettings teams who can help find you tenants and manage your property. And then, yeah, essentially give advice and support up until the day you sell it. And we can help you sell that property and realize returns as well. So we are very much experts in our field. And to kind of reiterate that, I suppose, in terms of our experience, we've been running for 16 years now. And in that time, truly globally, bought into 5,500 properties to the tune of about $3.2 billion in that time, bought and sold by IP Global. So we've seen absolutely everything in the property world and different developers and what, you know, issues can come up and so forth. So we have the teams and the experience there to support and help throughout the process. But today as well, it's not just about working with IP Global. This is about how you or anyone fundamentally can look into property as a base asset class and try and learn to make money from it. Now, well, actually, what we could do here is look at a poll to start with. And I'll launch this now, just a bit of fun, partly just a bit of information for everyone to look at. But I'll keep this up for a minute or so, but this will come up on your screen now. And it's just out of interest, really, to see where a lot of people are in their investment lifespans, I suppose. But what we have here is, you know, what have you invested in before? You can pick more than one if you'd like to, but here we have real estate, you know, we have stocks and shares, currency, and we're including, you know, the new player on the block, crypto here, and then none of the above, potentially. So just a little bit of interest to see who has been investing and largely where, and I'll in a second I'll show you the results of that. But to start then, obviously with Si, you know, what you're going to be sharing with us is going to be all important today about real life experience. I mean, do you want to give just a little summary, I suppose? Where were you in life? You know, the point where we're talking now, when we're just starting for it, you know, what was happening in your life and what were you thinking about property and how were you getting into this field?
Yeah, sure. So this was again in 2017. I've been working for about, you know, 3 or 4 years by that point, and I've been slowly squirreling away some money, as we all do, in just a regular bank account. And I felt like it was getting to the point where I just needed to have something to do with that money, because it was, you know, it was just sitting there, just gaining interest. And I wanted to have the ability to actually make it work for me as another form of income. Now, I don't know if, you know, many of you recall, but in 2017, you know, Brexit had recently occurred, and, you know, the US elections was, you know, Trump was recently elected. So it was a lot of uncertainty in the market. So I was a bit unsure about what I wanted to do, and I had by no means enough money for property. But it just so happened at the time, a coworker at IP Global, colleague, he mentioned of this asset that was coming onto market that just barely fit the profile of what I needed in terms of, you know, capital requirements. So I, you know, did my due diligence, checked my own cash flows and, you know, expenses, seeing what was necessary to be paid out, and the rest was history, basically.
Great stuff. And do you mind saying, like, where was it that you did invest in?
Sure. It's in Berlin. It's a tiny apartment in Berlin.
Yeah. Well, it's probably one of my favorites. I mean, we can talk about that a little bit longer, true. But you give yeah, exactly, a bit of the warts and all view of how it's been going. So moving on then, just, you know, why should I invest in property? Now, to talk about this, really, we're going to have to compare it to, you know, other investments that it's possible to, you know, put your money into. You know, we're doing this really to, you know, take a kind of educated, you know, bet on, you know, the futures of certain assets, and hoping for some kind of upward shift in the long term. So real estate is probably what we call an illiquid asset, which a lot of people in the property world, I suppose, would or in the world might consider one of the negatives. But certainly for me, I kind of think this is probably why property represents at least a significant proportion of most investors' long-term portfolios. You know, it creates the backbone of it. It's the less volatile, core structure of people's planning. It's a larger lump sum investment. Properties don't cost nothing, but because you can't, if times is potentially bad and stock markets flying up and down, it's not that people can't go and sell it very quickly. That means that that the prices don't shoot up and shoot down as they would do on speculative trading. So that's why we've seen all around the world, the foreign investors will be buying into long-term safe haven places like the UK or Germany, like Berlin, because they represent less volatility and a safer kind of investment. So, and if we pick well within that, then you can find very, very good returns, but it's something which it very strongly holds its value and should see good return in different ways. So property can provide that, in not just in rental income, but of course, you potentially can have property prices going up over time. And so if you pick well, then you can get a mixture of both of those. And how you buy will dictate how you make your money from a property. And we'll talk a little bit about that more with leverage there. But a lot of people like property because it is control. You can be in charge of the property itself. You're not giving money to a fund manager to make decisions on your behalf, and then you can decide as and when to sell or what to do in terms of, adding or increasing your potential mortgage on the property. And it can come with tax benefits as well, depending on what market you buy into, what stage of life you're at, and so forth. There could be certain markets, a certain way to buy to decrease your tax liability on investments. All investments, when you make profit, tend to have some government want to take some part of that. But there are ways to kind of protect yourself largely from that. So property is certainly a long-term asset. It's not something we can come and go into on a very short-term basis, and it does have a little bit more cash required to get into it. But it does represent certainly the kind of one or more lower risk assets that you possibly could be buying into. Now, moving on then, the important thing is how to make money. And the last point we had on there was leverage. And what we mean by leverage is mortgages, and it is probably one of the most important things within property. It's one of the only asset classes, or if not the only asset class, where you can use someone else's money to get into the investment. And this is with a bank's lending. A lot of us, if you're first-time buyers or not necessarily heavily involved in lots of investments, might have kind of been brought up with the idea that debt is bad. But I think when it comes to property, if you're buying into a safe developed market, one which is not going to be volatile, then taking a mortgage and using a bank as a business partner effectively in this, which is your business, this property you're going to buy, that can be one of the most useful tools in investment possible. And by this effectively mean that you suddenly don't have to put all of the value of the property down. You can only put, say, 30% of it down, but you only have to pay the bank the privilege of a bit of interest on that loan for the time you have it, but you get to keep all of the profits of you got the rental income coming in, but then you get the capital growth of that, and the bank won't take any of that capital growth. So in a very layman term here, what we've put up on this slide is an investment looking at it in two different ways. You can certainly argue that buying in cash is potentially the lower risk version of doing it, because you don't have any debt and it doesn't matter at all, I suppose, if markets go up and down in the same way. You can't get into negative equity, we call it. But you just get the rental income and then the growth, but proportionally the amount of money you can make on that is less than if you borrow from a bank. So we can see here, this was an example actually of a property we had in the north of the UK in Leeds. Just so you know, that's the price there, 159,000 for a one bed there. For a cash purchase, someone's going to need to spend 168,000 in total, but with a mortgage you only need 30% plus costs, so it's going to be 56,700. You both get the rental yield, and by yield obviously we mean the amount of rent per year in relation to the property price, basically. So 12 months of rental income comes to a certain percentage, so that's your annual take home in yield. But in the first example, you have very little cost. You don't have the interest in the mortgage, so you make possibly about 50-60% return on equity. In this example, up to 80% return on equity if you sold in year 10. If you sold near 10 with a mortgage example, you make the same amount of capital growth, but the rental is basically been covered by the mortgage payment, so you don't make much income in that time, but proportionally you've made a lot higher percentage return on your investment there. So the advantage we have here is you're buying into a low risk asset, hopefully, which you can then leverage, use someone else's money to get into it, which means that you can either get into better value, better properties to start with, or you can spread your money into multiple assets and diversify, which is certainly a tactic which lots of investors take to massively speed up your retirement planning. You know, if you're potentially getting to your 40s and maybe a little bit behind, leveraging on property and property growth is certainly one of the quickest, best ways to do that. Si, what was your, your position when, I think you said, you did take maybe a mortgage there, but I mean, what was your opinion on it at the time? I mean, would you have taken a mortgage? I mean, would you have bought it cash if you had the ability to? What was your mindset at that point?
Yeah, so for me, it wouldn't have been possible first and foremost without a mortgage. I do see the benefits if you are looking for a stable cash flow in the near future to buy in all cash. But for me, it wasn't a necessity. I was looking for more capital gain at the end of the day. And, a mortgage just made sense that I could, have my rent pay off portion or all of the mortgage and just keep it aside and not have to think about it going forward.
Well, I think in my experience, like an awful lot of the time, a lot of that's dictated by age. I think that's the absolute perfect scenario for most property investors, that you can put down a lump sum, have the rent cover the mortgage, so you don't have to subsidize it at all, and then let the property go for X amount of years and not have to worry about it. And in an absolutely ideal world, we might have a tenant which you barely hear from and doesn't call you on issues and just pays the rent every month, which mostly happens, but obviously we deal with humans here. But yeah, I mean, I think in terms of what we're dealing here with a lot of the time with whether you're going to take a mortgage or not is partly the question about your risk profile. So, so basically what we're thinking of here is now we get the idea of, we understand that property is this good investment asset and, it makes sense on a fundamental level. How do I as an individual relate to that, and what should I be looking at? What should I be getting into there? And there's a few different questions we can ask ourselves here. Firstly, and most importantly, I think an enormous amount of people might make this mistake to start with, is detach yourself emotionally from the decision. No one particularly has an emotional decision when they come to investing in stocks and shares or gold or commodities or other traditional investments which you might do. But they all do when it comes to property, because we all live in one. So everyone's got an opinion about what it looks like, even if they kind of can partly let that go. So I'd say the first thing you should do in any property decision is forget yourself in the equation largely. Obviously, we don't want to be buying something which is like horrible objectively for everyone, but your tastes don't necessarily rely on everyone else's. So being able to just understand generally people and certain areas and how people are going to live in that area, that's going to be the most important thing. So I will now move on to the next slide. So this is a self-assessment exercise we'd had a think about, and this is about asking yourself these very basic questions, really, just put you in context of property, I suppose. And it's not about saying, what's my risk appetite? And some people might say, look, I'm feeling bullish, I've got some money behind me, I want to go for something which is super high returning. A lot of the times, sensible property isn't that. But, when we're talking about risk appetite, it might be that high risk property might be just outside of where the people are. Low risk property might be more like city centre, more where there's much more demand for renters. So it might be slightly more expensive property going to either in the cities or surrounding areas. But equally, what we think about risk in terms of property is rental yield. And a lot of people will focus and chase rental yield, thinking that effectively the higher it is, the better it is, because that's what it looks like in terms of return. But just remember that rental yield in property is a direct reflection of risk itself. So it tends to indicate either a much cheaper property, and cheap probably comes with certain reasons. So, you might be getting into an area which is less in demand, harder to rent. The tenants you find might be more difficult, and so you might have more and longer vacancy periods within it. So it's just a case of where globally, and then where within certain regions, you know, might be sensible to buy into. What your timeline is a question to think about. It is, property isn't a short-term game. You know, it's something that if you're kind of wanted to buy and sell and get in within 3 or 4 years, it probably just isn't for you. There's probably other assets that you can get into which would give you returns. But yeah, property is something you should buy and hold on to the medium to long term. So, you know, an ideal scenario, 10 years, and some people might want to hold on to a property forever and then pay it off and have rental income in retirement. But really, yeah, just think about that in terms of the timeline there. You need to allow them to do its work for a period of time. So what your age is, like Sai's position at his age, I suppose that largely dictated that he's got the time on his side and he can go and take a mortgage there. Your age it will affect basically your decision about what type of property you buy, because the closer you are retirement, the less mortgageable you are, you know, the less worthwhile it is to take it. And you also might be more inclined to be getting something which is going to give you passive income, you know, or direct rent for when you are, you know, stop working and need that extra income. So yeah, your age dictates as to how and what to buy. Budget isn't necessarily about make sure you've got enough to buy, you know, in good city areas and so forth as well, but actually it maybe sometimes is a little bit of a warning about, you know, making sure that you're buying something which is investment worthy. Just because something's affordable doesn't necessarily always mean it's worthwhile your time. So thinking about the budget, don't necessarily rush in through the, you know, the flashy figures and so forth, and thinking because you can go and afford to buy one or two. Do the research, get behind it, and understand that actually it's a sensible decision, full stop. And currency wise, I think a lot of people forget this. I mean, you know, obviously we've got a fairly global audience on today. I've seen, you know, roughly where some people are based there, and you know, a lot of people might be paid to the US dollar. But whatever your currency is, that really should dictate and make a big decision as to what timing is right for what markets. You know, the UK has been very attractive over the last few years. You know, if you hold dollars. But it has bounced back a little bit now. Long-term averages, it's still probably low, but it is important because what you don't want to do is to buy into a market which currency rebounds heavily against yours, and when you pull the money out, the returns you've made might be kind of cancelled out by currencies being worth different amounts. So it's very important to consider that when choosing where you're going to go. I mean, so it's slightly putting you on the line, Si. I mean, like how much of that did you go through, I suppose, when you were in your journey?
I would say a portion of it, definitely not as detailed as that, I would say. Definitely had a hard look of where I was, what I was going to be, you know, relatively young, so we're able to plan out, you know, okay, this is where I foresee myself being in the next 5-10 years. The thing I think you pointed out was more on the currency side, which I didn't really consider as heavily at the time. But, you know, given that I invested in a market which I think was personally quite stable, didn't have as much of a fear of that, I guess, even looking at it now. But definitely something that you should consider is currency.
Yeah, no, absolutely. And you know, I think once, you know, that by no means is that a comprehensive structure of how and what you should invest in, but it's a good starting point is to maybe put the red flags up for certain things to buy into, you know, and just make sure you're making the right decisions. You know, I think, like we said a number of times, you know, the major issue is sometimes with any investments, or particularly properties, those people, if you're maybe new to it, you don't know what you don't know. So there might be, you know, not having thought about the currency, you might not have thought about certain costs throughout the process or your obligations at a certain point. And we'll look a bit more into that in a sec. But I mean, that's you know, doing the research first is key, and largely this is what we're going to look into now. About, you know, now you've decided you're interested, you want to make money in this way, you've got time in your hands, you might take a mortgage, and you want to get into it. How do I go about picking? It is a a vast world of property, and lots of things are on market and sale at various different prices and territories and so forth. And there's no particular right or wrong answer for a lot of the time, but certainly our philosophy as a company is for low risk, stable markets which are going to grow, and not taking, huge punts on kind of, fastly developing markets which might also have, big risks attached. So this is the kind of overview and simplified version of research, and this can be done by an individual looking into their first property, or it can be done, like say, by us on a kind of macro level. But these things are all important. This is essentially the bloodline of how a property is going to succeed. And first and foremost is top left one here, housing supply and demand. More than anything, that dictates how healthy your property investment is going to be over the next coming years and decade. And so you want not enough property being available for a growing population within that. And so all the other things here, which are super important, they're all dictated by that first one. You can have a very healthy economy, but if they've got too much property, then you're not going to see a surge in house prices unless it's speculative, which is dangerous. So supply and demand is key. Not enough property is what we're looking for. And that population, all those renters, we want to rent our properties, we want to have them be wealthy enough, a broad range of different jobs within that, and for them to be upwardly mobile, and people who want to spend more and more. We need that competition to be there. Economic outlook can be on a country level, can be on a city or a region of a city, but we want there to be, incentives in there. We want there to be public and private money being spent, new companies starting up there, and people getting paid well in those areas. And if then ideally our investment team can find it as well, regeneration and infrastructure changes, that can be massively impactful. And this can happen on a big scale, on a small scale, but infrastructure could be different. New roads, a new rail line, new tram extension, new airport, anything like that. Effectively, what we're talking about is, when I buy this place, it's going to look very different in 10 or 15 years' time, and probably then have a different demographic of people there. So, if not completely changed, at least on the upward curve of desirability, rather than potentially a downward curve of nothing been happening there for a while. And that's the way to kind of fundamentally get the strong backbone in your decision to start with. Understand people in that area. You don't have to love that property itself, but you have to understand the people in that local area will. And then you come to the micro research, but when I say micro, basically we're just coming down to the building or the development or the street itself there. So, develop a track record. It's just important, like any investment, anything you buy from anyone really, just to know that, a good quality is being built. They know what they're doing, and you're not buying into, taking chances with new companies or people who basically might be learning themselves in the process. So, check that out. It's almost always researchable. Ask the questions about it, and you should be able to get answers there. Legal obligations. We only work in markets which have years and years of legal, history and backing there. So both the buyers and the sellers are protected. There are markets around the world which aren't terribly well protected, or if the laws are there, they're not very well enforced. So, for our core markets of Germany and the UK and Portugal, they are very black and white. If X happens, then Y will follow. But yeah, just being aware. And a lot of this is about doing your DD and checking into it and knowing what the costs are going to be. Price comparables. That's actually a really nice benefit for property, in terms of it's very transparent. Most developed markets have easy portals online. You can go and check to see pricing. And be able to compare like for like, and that's important though. Make sure you're comparing a similar property to a similar property, a new one to a new one, an old one, and same size and same location and so forth, so exactly what price is fair. And then asset due diligence. Essentially what we're talking about is the property itself, and again that comes to research. What service charges there might be on it. Don't get caught out effectively. Just understand exactly everything that's going to be in there, in the whole process. Size, both from your side and research. Did you face any challenges that way? To be fair, you probably did have some help. You did know IP Global at the time as well. But how was your experience within research?
Well, I definitely feel that at the end of the day, the onus is on you to understand the market that you want to invest into. So you have to take an active stance in understanding the market, the asset, and the legal framework of what you're planning to invest into. Now, luckily for me, IP Global was there for me with regards to ensuring that the legal side was sufficient. I did my own research, as easy as Google, right? You could go on, find these, larger institutions that do research on macro levels or on the property level or on the, the location itself. And you can get a lot of information just on, what it's deemed to be like in the next few years, how it's going so far. And I think, just not being afraid to ask questions, from people who have invested in the area before also really helps paint a good picture of what you're potentially investing into.
Yeah, absolutely. Asking around, getting different opinions and so forth, and asking in the right quarters. Like the more information is better, basically. And base it on facts rather than opinions a lot of the time as well.
Exactly, yeah.
So yeah, here I think it was important to put in here, at the slide about the common pitfalls, and a lot of this comes down to research, and just looking for the right things basically. But some of the ones which people, like we said before, you don't know what you don't know. So you might not be looking out for certain things. So from experience, I think asking for a developer, when you're putting deposit down, largely, and we're thinking about off plan here, if it's going to be a year to 18 months. You want to know that deposit's protected. Most decent developers, or by law, really should have a warranty in place to protect that deposit, or at least the first 10% of that by law in the UK. And different markets have different options there. But you do want to make sure that the developer is right. They put their finance in place, and then that your deposits are protected to the best way possible. Finance is a big one. Doesn't have a specific pointer here, but it's quite possible to do proper pre-vetting on your eligibility for mortgages. Don't take the chance of hearing that 65-75% mortgages are out there in market, and you think you're sure it'll be fine. You can go to a broker, do a fact find, and go through the process and double check yourself. It's not a legally binding to say that you'll get that, but it's going to flag up issues that might come up in the long term about your affordability compared to the property you're considering. And just to get a view then of realistically what the interest rate on the mortgage look like, how much they're going to willing to lend you, because you just don't want to be in that position where that you wouldn't have a bank who's in that available at the time. Particularly, that's going to be more relevant for in the UK, particularly for self-employed people. It's much more difficult to get lending if you're self-employed. You need years of audited accounts to show, and that certainly can be difficult for where I am in the Middle East, where we don't have tax returns in the same way. So. But yeah, tax, legal fees, mortgage fees, service charges, all those things are completely transparent, or should be, with any provider you're dealing with, and be able to get full lists of, what all the costs are throughout the process. And when it says potential unexpected costs, is in, ask around, ask for a full comprehensive list of what could be involved in the process and what those are. And every property should be able to show those to you. The tab here saying profiteering. This is just a reflection, I suppose, of, a lot of the property world is very sales focused. So it's just being aware of what's out there. Like we all know, if it's too good to be true, it probably is. And so it doesn't necessarily mean it is, but it's worthwhile looking into. So, if you see things which is quite right from property, things are below market value or being sold for less than they're worth, generally things aren't sold for less than they're worth. So that's pretty obvious, but don't be suckered into following the dream. Make sure through research it is the right price and it's real. And similarly with things like incentives, you're getting a free furniture, or you might get a rental guarantee for a certain period of time. There's nothing intrinsically wrong with those, but go and ask the question: who's paying for this, and how is it being paid for? Because if it's being offered up front to standards, it probably, or could well be, that it's just been added onto the property value to start with. So you are paying for it, but it just feels like it. It's not to say that we don't occasionally offer a rental guarantee ourselves, but we can be quite transparent about it and show that effectively it's being taken off our bottom line and not yours in that way. So it's just be aware of what to look out for. And liquidity and exit strategy. you want to be able to know whatever you're buying into is sellable in future. So you just want to know in that market, is this going to be sold to locals there who are going to want to buy that for, you know, the profit that you hope to make there. And it's not something that you have to sell to investors based outside of the country, which potentially sometimes can happen. So just a few little things to bear in mind. Now, in terms of your planning, then your cash flow and you know what to go for. This is just to show a basic snapshot of a lot of the costs throughout the process. You know, so you have a different stakeholders who are going to be helping you in a purchase of a property. Now, maybe your original agent, you might have your lawyers who are acting on your behalf. You've got a mortgage broker and the bank who are getting your mortgage, and then you might have a letting agent in the end who might be sorting out your tenants. So might be a few different people there, and therefore they have a few different fees there. So that's absolutely fine. And it's just being prepared for it and understanding what those costs are, so you can really plan that from the very beginning. So, you know, all the costs up front of buying, and then all the costs on a monthly basis of, you know, when the rent's coming in and how much that, you know, is coming out for tenant management fee or service charge in the building and so forth. Because that's a true then cash flow that you're planning for a long-term future, and it makes, you know, you can understand what your real returns are. So yeah, it's not just about your deposit, it's about the cost of buying as well. So there's a very brief oversimplified view. You can probably expect to be paying anywhere between probably 5 to 6 up to 10% of the property value in acquisition costs of getting it sorted, and that's from the government acquisition costs to the legal fees to all those third parties basically who are helping you to set up this business of the property. Any comments from your side, Si, about kind of things you learned there? I mean, cash flows can be kind of exhaustive and long-winded, you know, and then you can go down a rabbit hole there, but it's
No, I think, you know, you voiced it very clearly. There are a lot of costs that you have to consider. Not that they are extreme in any way, but it's not just the property value you have to consider. There are the costs you have to consider that go into it, including, you know, tax or any other, you know, vendor service providers that you use. You just have to include that in your final bill.
Yeah, exactly. Just with your eyes open, I think that's it, isn't it? And by all means, actually, because we have pretty detailed, you know, Excel breakdowns of all the different markets we're into. So purely on a, you know, interest level, if people want to kind of see those for, let's say, the UK or Germany or Portugal and what costs are associated, please do ask, and we can, you know, send you something bespoke or, you know, just an example so you can, you know, create your own for planning. The last thing then, the last point we want to see is just, you know, the reality of what it looks like. You know you're doing it then, you pick the property, you're going to go into it. And, you know, of course, this changes slightly from different market to market, but just to give a basic view and experience of what it looks like to buy. Because as I said, you know, there are a lot of different touch points throughout the process. And I think this here is something we put together about, you know, the light blue being lawyers, the dark blue being lawyers, your agency might be the light blue, and then you've got the bank basically being on the orange. So there's different action points throughout the procedural process, but this probably looks like it's a bit scary or lots of times, and actually the process works quite smoothly when you're in it most of the time, because these are professionals and they're working on your behalf and you're paying them a fee to help you do that. But it's just being worth understanding when you go into it, what you're going to be asked for, who you're going to have to give information to, and how they're going to help. And so this here is applicable for whether you're buying an off-plan property or a completed property. If it's completed, it's just condensed into a shorter period of time, simply as that. So, and it's also assuming on this one you're going to be taking a mortgage. So there's a simple idea. If someone was going to be buying a property now, you have a reservation fee, you'll have some basic legal paperwork. Both the lawyers, the bank, and so forth, they're going to want the same kind of information from you. So it's your personal information like proof of ID, which they might want to get certified, proof of address, which they might want certified, and proof of funds. So maybe a stamped, 3-month statements from your bank. That's a standard 3 documents that most, you know, people in this process are going to want to see from you, basically just to kind of do their legal checks and make sure it's there. So be prepared probably just to be able to provide those 3 times in the process to the different people in the process. Or if you're clever, when you're getting them the first time, just get 3 separate copies of it to save yourself a little bit of headache. But point is though, when you do then come to completion, and then you have a tenant agency, letting agency look after you and find a tenant for you, start managing that. That'll be a repeating cycle. So you'll have tenant stays in there for a year to 18 months, and they'll find a new one. And this is the point. Your journey doesn't end necessarily. At least with us, when the property's purchased, this investment runs until the day you sell it. So there's hopefully as few things to do as possible throughout that time, and it's quite possible. Occasionally, of course, you might have a small thing like a repair or something to do in the apartment, but most of the time with at least new build, then you should have a number of years of relatively hassle-free time in there. What would you say on this side about your experience of the actual process of buying?
Yeah, so as you mentioned, there are a lot of components, and it does, when you are at the start of it, it does seem very daunting. But, given that it was an off-plan, and I don't know, Jeremy, maybe you want to explain what off-plan is in a bit, but given that there's a time frame that's quite extended from the initial commitment to the final payment, there is there's a lot of time to get all of this sorted. So while it does seem very daunting, there's enough time to get everything done. But just on that also, this is still a real tangible asset, and things don't always go necessarily to plan. That's not at fault of anyone per se, but you do have to work around certain items that may come up that don't necessarily follow the plan. At the end of the day, you'll still get it done and everything works out, but it's just there sometimes needs to be a bit of jumping back and forth or shifting around.
Yeah, no, I think the way I often kind of think about that myself is, you're dealing with an investment asset which is lived in by a human. So and exactly, the humans deal with that person, and look after them. Sooner or later, it's physical. Something is going to be need to be upgraded or changed on it, and or someone living in it might have a small complaint. 99% of the time it's a small thing. But yeah, it's we roll with the punches on these ones, and from my point of view, certainly, and of course I would say that I think it's important to then have people working for you, on your side at least, who can do that work and do it relatively smoothly with no headaches involved, and understand what it takes, particularly for if you're going to be a foreign landlord, to not be too close to the ground, and understand on how to translate that into real life scenario.
Yeah, definitely. It was really helpful to have someone at IP Global assist me with things that needed to be done or changes to the plan. It was good to have someone that I could rely on in these moments.
Yeah, no, absolutely. Well, I'm glad to hear it. But so yeah, look, in terms of the full spectrum then of the journey, I mean, that's all we want to cover today. That you could talk for absolutely hours about all the different intricacies of what to do and so forth, but as the core fundamental of how to go about buying, what to look for when you're investing and so forth, all that makes anywhere in the world, whether it's stuff we used to do in Melbourne or Tokyo or US or currently in Europe, like all of it is picked on the same principles of movement of people, supply and demand, and that's what keeps a healthy and safe property investment. But like now, I know there's a couple of questions have been coming in, but as I say, it's very much an open forum, and please do ask, whether it's to me or to Sai or to generally questions you might have on it. Please add them into the Q&A box you'll see on the top there. I'll start with a couple here. It's quite, I suppose it's quite open-ended. It's about asking Sai, directly one for you. It's like, what mistakes did you make, if any, in the process? In terms of
Yeah. I think for me, it was I was a bit gun-ho in setting up, everything, getting everything ready to go. I set up my own bank account, for example, in Berlin, and the first bank I used for no reason just closed down the account, and so scrambling to find a new bank at that time. Then I liaised with IP Global to help me as well, and just, you know, working through it. So it's just, you know, I think for me that was a big problem, but it managed to get sorted quite easily with, you know, the assistance of those who actually knew the market quite well. So I guess what I'm trying to get at is it's important to do your due diligence on the service providers. It's important to, you know, have people that can advise you as well in, you know, before you sign up with any service provider.
Yeah, well, actually, to be fair, I think because you were 2017, I think, with that particular one in Berlin. So if I remember rightly, actually, I don't think we set up bank accounts as part of the due process at that point, did we? So I think, you know, maybe if you did it yourself, I mean, you're probably introduced by the lawyers, but you know, again, that's something that we kind of learn, and well, for the last 2.5 years now, that's part of our standard process. So, you know, if there's a potential hiccup like that, that's something we would try and take on ourselves, basically. So yeah, stress is something we want to avoid on your behalf, certainly. So what's this one here we've got? So okay, the simple one actually, how much do I need? I mean, it's a fairly open-ended question, I suppose, because that completely depends on what markets you're going into, I suppose. But if we're talking about, you know, we as a company have a baseline, I suppose, we go to, because it often is not worth the investment, or it's much more difficult to get mortgages on cheaper properties. So so actually we start in the UK by probably around about the £140,000 mark, because then you've got a number of banks who will lend to people there. So if we take that as the cheapest possible example, I suppose, then you'll be looking at what, about 30 to 35% of the 35% of the property value plus costs. So you might be looking at minimum about £50,000, I suppose, and upwards. And as much as there is, yes, off plan, which can be useful for tapering your your payments, I tend to want to think about the full investment amount. I don't like people to kind of go, well, I can afford to do the first 15-20% now, and I'm sure I'll be able to save for the next amount in the next 18 months. For me, that's more of a high risk scenario. You don't need to be putting yourself into, you know, it's wait longer to save longer, I suppose. I don't want to be kind of, you know, betting on future income to be getting into an investment. That's not the way it probably should be doing. What type of property basically is what they're saying there, and basically it's kind of saying house versus apartments, or if apartments, what is it in terms of 1 or 2 or 3 beds there. There's no right or wrong answer, I suppose, apart from you want to be thinking about who your rental demographic, who's going to be filling that up. And it's easier, and there's more people who will fill 1 and 2 bed apartments, and particularly in city locations, of course, than there would be the bigger property you get. So, and also then it probably means that there's slightly less people who can afford to buy when you're looking at the larger properties as well. So both in terms of your rentability and your scalability, I suppose, liquidity, in the end, we tend to focus on 1 and 2 beds, sometimes 3s, sometimes studios as well. But, you know, on average, 1 and 2 beds being the core interest ones. I think we should we want to look at. As you, I mean, well, I think you probably have opinions, right? Off plan versus completed, you mentioned there, Si. I mean, obviously, to potentially kind of explain off plan. Off plan obviously means the property is still in its construction phase, which allows you to get in early, and it should be then probably getting good value. You know, probably worth a little bit more when it completes. But it allows you then to put a small deposit down and then potentially nothing until it completes there. So the argument, I suppose, to whether to go for off plan or completed is twofold. Both have got their advantages. Completed means there's no development risk there. It's ready to rent, and you can go for it. You're probably paying slightly more for it at that point, but you know, you're getting the privilege of having something that's ready with 0 risk. Off plan, in theory, then should allow you potentially to disperse your funds a bit slower. You know, maybe you've got other investments you're interested to do as well at certain points, so you know you can put down a bit now and a bit later on. But also then it should be able to get you some extra value in a certain market. I do get people asking sometimes about the, you know, but doesn't it mean I'm missing out on my rental income if I get something which is, you know, off plan? Why wouldn't I get it now so I can get the rent in? probably 85–90% of my clients are probably taking a mortgage anyway. So in most scenarios, you're not missing out on rental income because your rental income is being matched with your mortgage payments coming out anyway. So cash flow wise, it's no difference to you, you know. So you're buying into a property in, you know, this year at this price per square foot, and then holding on for a period of time. So in that respect, it doesn't make too much difference. So it's just a question of you know, construction risk potentially, and you know, opportunities there. I mean, obviously you've gone through the off-plan experience size. I mean, it's I mean, for Germany, it's next to no risk, I think, isn't it? Because they've got so many protections in place there as well. But how do you find that?
Yeah, exactly. So I personally did not have an issue with off-plan. I definitely couldn't have, as I said, you know, a mortgage was necessary and off-plan was necessary in order for me to achieve this. It allowed me to, you know, forecast my own cash flows as necessary for the property. Mm-hmm. So, you know, it just made things a lot simpler for me at the end of the day.
Yeah, no, fair enough. So looking at some of the other questions coming in here, a fairly broad one. I mean, like, so someone, a very easy one, we can say, are you able to help overseas clients to open bank accounts? This person potentially from Hong Kong, where you are, Si, and then will we be able to get mortgages for people based there? We're only really interested in buying into markets which have gotten different banks who will lend to expats, and so certainly, you know, Hong Kong is absolutely fine, and yes, we can help open bank accounts in these markets for, you know, with you. You know, there are some occasional blacklisted countries which the banks don't like to deal with, but really we're talking about pretty obvious ones here, like, you know, Syria or Iraq, or, you know, countries which don't let take the money out and so forth. So, you know, yes, mostly around the world, it's absolutely fine. We can get you, you know, 65 to 70% mortgages in most of the markets we're looking at, and you know, currently interest rates are the lowest they've almost ever been. So, you know, I think that alone is one of the principal reasons why property is seeing such a boom at the moment. You know, particularly in our European markets, you know, Germany can be as low as 1.5% interest on mortgages, which is enormously appealing. I'm not sure they had those rates available when you bought Si, so you're probably frustrated to hear that. When it comes to renewing your mortgage, though, you'll be able to take one of those. But,
yes, I believe I'm also going to transition to a float on my mortgage, hopefully in the near future. So
yeah, no, that's all good. Well, it's the same. A lot of these banks we deal with are pretty flexible, actually. So, you know, when you get into a mortgage term, which is 25, 30 years or so forth, you know, it's not that's it, you're stuck into that. You know, you'll have like periods probably every 2-3 years, or it depends, different markets, different options, where you can effectively renegotiate or leave them and go to a different bank. So, you know, but it's you know, with interest rates being historically low, that's really good for us buyers, largely. Similar question about the taxes then and incentives, basically saying which is the best markets to go into at the moment, just full stop. But particularly in regards to that, the lending and taxes. And I have to probably follow Si here, as in, like, objectively, Germany has Germany, UK are the biggest markets we're dealing in, probably in terms of safety margins. But particularly Germany has got, if you buy and hold a property for 10 years, then you don't have to pay any capital gains tax on there. So tax is something which is a necessary evil in successful property markets, and most governments will, in any investment, take a proportion of your earnings once you've earned them. But Germany has this very Germanic, you know, law, which means that you, if you hold a property for a sensible long period of time of 10 years, then they're not going to charge you any tax on all your profits. And so comparing that to other markets, that's an enormous boost of your full return on equity. So yeah, for that reason, I'd probably say that's the front runner. But yeah, in terms of GDP growth and, you know, expectations and so forth, both Portugal and the UK have got some, you know, obviously really good options as well. Time-wise, I think we're probably coming up to the end of it now. There are quite a lot of different questions still out there, so apologies if we can't answer everything, but we will get back to you individually afterwards. So do fire them across to us, though. You know, we'll have a follow-up email to say thank you. By all means, please reply to that, asking for any particular information you'd like. or if you'd like to have someone contact you about it. But I do hope you've learned something today, given a little bit of extra flavour to what buying into property looks like. And yeah, we'll look forward to speaking to all of you or some of you in the near future. And thank you very much to Si for joining us and sharing some of your life story in property.
Sure. Thank you, everyone. It was a pleasure.
Yeah, pleasure. Thanks a lot, Si. Speak soon.
Take care, everyone. Bye.
Bye.